We're now halfway through 2024, so it's appropriate to evaluate the year in the markets and the economy. The best way to describe both, remarkably resilient. Stay tuned to the end of this video. We're going to talk about how the setup may affect you as a young investor versus as an older investor. As always, if you like this content, please subscribe to the channel. All right, let's start with the economy. It was expected to cool given the drag from higher interest rates. And while recent data seems to be showing a modest slowdown, the economy has largely held up better than most people forecasted. Inflation is moderated without crushing the economy. The regional banking issues of a year ago, they came and went without a full-blown crisis. Commercial real estate, while still under pressure, has not been as bad as many people feared. And GDP, it's humming along right now at a slower pace, but nothing close to recessionary. That doesn't mean each individual, family, or business is having a similar experience. Far from it. If you look at the government's monthly jobs data, businesses continue reporting solid job growth. But when the government asks individuals, they're finding a higher rate of people saying they're unemployed. And that divergence is part of the ongoing story. Whether we're talking about households or businesses, those at the top are faring better than the rest. Higher interest rates weigh on those who need to borrow more money than they can save, but they propel those who can save more than they need to borrow. If you've got plenty of cash, you can outpace inflation by simply holding money market funds, CDs, or high-yield savings. You can see that reflected in the vast dispersion in the markets. So far, 2024 is playing out very similar to 2023. Small companies, as reflected by the Russell 2000, are barely positive on the year, and actually negative over the last 3 years. Meanwhile, mega-cap technology companies have performed far better. Top companies in the NASDAQ 100 have vast amounts of cash, and they have growth that is expected to produce even more. So they simply don't have a pressing need to borrow greatly at today's rates. The S&P 500 has more growth than the Dow, and that's why the S&P is doing better than the Dow Jones Industrial Average. On the surface, the markets are having a terrific year. Under the hood, it's more mixed. Those floating in the river of AI, artificial intelligence, are being pushed forward by the current. Meanwhile, a large chunk of the market is stuck along the banks, treading water. How to think about the future, because that's really what matters. The market gets fixated on particular areas or narratives just as we do in our own lives. Right now, the market's fixated on artificial intelligence and the increased productivity that it may bring. As long as the economy holds up and the AI story remains intact, the market's focus can easily remain there. But if either narrative falters, the market will likely shift its focus, and that will introduce new opportunities and new risks. It's a fool's errand to predict how or when that will happen, but it's the reason you want to remain diversified, even if it seems like the only place to float your investments right now is in the river of AI. Okay, so how does this matter whether you're a younger investor or an older investor? If you're a younger investor, you likely don't have a lot of money already put in the markets. You've got lots and lots of future investments you're going to make over the coming years and decades of your career. So you have time for things to smooth out. If there's overconcentration in the S&P 500 or the markets in general, it's not as big of a deal because things will kind of smooth their way out over time. You're continually adding new money. You're fueling that new growth. So if the markets sell off, you're buying at those lower prices. If you're an older investor, you're late in your career, or you've already retired, you have less future investment dollars that are going in. And that means you're more susceptible to those drawdowns. So concentration risk within the S&P 500 or the elevated price that you're paying for every dollar of earnings right now, those are real risks to you because you could see bigger drawdowns without future investment dollars pushing in at those lower levels that will help smooth out the ride for you. So you have to be much more concerned about the volatility of the markets and how the path goes from here.